Hello, my name is Gabe Bodner with the Bodner team of OneTrust Home Loans, and I'm very fortunate today to have Jesse Allen with us, the president of our 55 plus division. Jesse, how are you?
I'm great, Gabe. Good to see you in person,
And
and I appreciate the opportunity to talk with you.
absolutely. Thanks for being here. I wanted to ask Jesse a few questions about what's happening in our industry at the macro level. Jesse had the opportunity to be at the NRMLA, which is the National Reverse Mortgage Lenders Association conference a couple weeks ago, and met with some key representatives there. And just wanted to hear from your perspective again what's happening in our industry. So, how was the conference overall?
Conference overall was great. It was one of the first conferences in person again post COVID. Funny that we're still talking about that. It is in 2023, but on the West Coast, primarily focused in on updating originators on the West Coast around the industry overall and some of the things going on in the behind the scenes that originators don't always see in the industry with some of the bigger changes that we've seen in the last 6 months.
Yeah, so with that being said, what would you say are some of the biggest changes that we've seen, whether it's regarding secondary pricing, whether it's regarding things that have happened with other companies in the industry that have gone under, right, or filed bankruptcy? I know that was a big talk.
It was, yeah, all of the above. So I think, I've been around the industry in and out since 2006, and I would say the last 6 months we've had more headlines than in any time I've seen in the industry, including the financial crisis back in '08. Now, some of those were good, with a lot of traditional mortgage companies really committing to serve more of the senior market through the product space. We've seen a lot of announcements this year with other major lenders getting in and wanting to serve seniors through the reverse mortgage product. I think that's great news for the industry overall. Some of it was on, the mortgage and real estate um, industry that in general is going through some tough times with rapidly rising interest rates and all of the uncertainty. And in the reverse space specifically, we've seen two of the top reverse mortgage lenders go out of business in the last 8 months with reverse mortgage funding and, of course, American Advisors Group, who sold off to Finance of America. And so there's a lot to talk about around the fallout from that, the implications of that. There's a lot of transformation going on in the industry, and that was largely the topic of discussion for most of the conference.
Got it. And with those fallouts of AAG and RMF, is that more on the servicing side of things, or how talk to me a little bit about the impact to the consumer and or the industry as a whole?
Yeah. So, well, the higher rate environment certainly impacts consumers no differently than the traditional mortgage space. The fallout from the bigger players was more on the back end of the business. So servicing, managing the Ginnie Mae bond and the pools and the commitments that come along with that. And so that's primarily the implications of the work that has to be done when you have a major lender go bankrupt as quickly as you did with RMF. You have a commitment to service a lot of those clients, obviously, and so Ginnie Mae and the industry has worked together to make sure that those clients have access to funds and continuity on the servicing side. So that's been the bulk of the work, and the industry and NRMLA, the trade association, has done a lot over the last 6 months to really make sure that those clients who were in that book of business were well taken care of. And that we saw opportunities to improve the servicing experience for both lenders and servicers and clients.
And on that note, I want to make a point because I think it's really important to understand that with the home equity conversion mortgage product that is insured by HUD, that regardless of the lender that originated that loan, if something happened to that lender like AAG or RMF, that consumer is protected. And therefore, no terms or elements of that mortgage can be impacted per se. Correct?
That is correct, and that's that is the beauty of the not so inexpensive FHA mortgage insurance premium that consumers pay when they do their loan. Absolutely.
Absolutely. And we've gotten a lot of calls from clients regarding that this was now back to probably December of last year in 2022 that were receiving letters from attorneys via RMF that said something about the bankruptcy, right? And that those clients would call with concerns. But again, I think that's a really important note that regardless of what happened to that lender or servicer, the consumer's protected, which is huge. Now, I believe, correct me if I'm wrong, that as an industry, we are only tapping into about 2% of the eligible senior population in the reverse mortgage space. Is that correct?
It's correct if you view that 2% through a favorable lens, which is the total book of business that the reverse mortgage industry serves today,
okay,
including new originations and the servicing portfolio. That is about correct. And of course, different research will view the market size opportunity differently. A good way to think about this when we're working with financial advisors, CPAs, elder law attorneys, or frankly adult children, and you think about the size of the market, and it's for me really who are the boomers and soon to be Gen Xers, which is the bucket I fall into, who are sitting on literally trillions of dollars of housing wealth, and who are going into or in their retirement years, who are undersaved for retirement overall, or whose savings couldn't withstand an impact, maybe high inflation like we see today, or a market setback, or unexpectedly needing in-home care or some other healthcare costs. And when you overlay the risk with a comfortable retirement, the research is very clear. And you spend time as a guest speaker in the local university here, so I know you believe in research. The research is very clear that homeowners and their families will have to somehow monetize that housing wealth and access it as a part of their retirement income stream.
Sure.
And so when you think about the market, the potential market through that lens, there are literally 25 to 30 million older homeowners, 55 plus homeowners, who may have to tap into their equity through some device in order to bridge the gap or somehow meet their retirement income goals.
Sure.
And you think about that against the context of the number of people the industry serves every year, which is a very small number, the market penetration would be considerably less than 2%.
Unfortunately, yeah, considerably less, but around 25 million eligible senior households today. Mm-hmm. And I just read recently that our median age in the United States has just reached the highest age that we've ever seen in our country at the same time. So we've got an aging population, right? We've got expenses due to inflation and cost of interest rates going through the roof, right? We've had market setbacks. Mm-hmm. And last I checked, we've got over $11 trillion of senior housing wealth sitting on the sidelines right now, 100%. Ready to be deployed as necessary. Is that correct?
That's correct. And in fact, the last number moves around quite a bit. It's 11 to 12 trillion.
Wow.
And when you think about the headwinds, Gabe, that you point, and this goes back to when I did my due diligence on whether or not to get back into the reverse mortgage industry in 2016, after being away for 6 years, having run the B of A business, which we exited in 2012. Part of that research, it was abundantly clear in the research that not only are those 25 million folks undersaved for retirement and with normal assumptions,
sure,
meaning I'm going to withdraw 4% of my savings every year, which no one really does. Okay, so that number could be 5 or 6, maybe in some cases it's 3, but if you just take normal assumptions and home price appreciation and normal life expectancy, significant numbers of folks are undersaved for retirement. Now you overlay what I call economic headwinds to that: healthcare costs, housing costs, unexpected things like inflation, some of the macroeconomic things you just mentioned. Now that number gets significantly larger, and meanwhile, they're sitting on the largest bucket of wealth in their home. And so how do you monetize that wealth in a smart, efficient way that creates choice and more optionality for homeowners, not less, mitigates certain risk out there, like the risk of your home value going down, or the risk of your retirement savings somehow going down, for market risk for the impact of your retirement savings in 1 year. So the housing wealth, the research will tell you, is a logical mathematical tool to offset some of the risk and create optionality for folks to navigate through those retirement years. Sure. Longer retirement years, by the way, which is a good thing.
Which is not a bad thing,
Yeah.
absolutely. And the research that I've read from Dr. Wade Pfau, at least, and when you look at the Monte Carlo, examples that he has put together in his research, he's actually proven the fact of what you just said, that if you utilize housing wealth earlier in retirement versus later, versus not utilizing it at all, that you'll actually improve and increase the probability of financial success in retirement, correct?
Yeah, that is correct. And the beauty of the business today is the research. We like to say that here today with what we can do, you don't need to litigate the case for leveraging your housing wealth as a retirement income tool. You can just be a witness, because the research, whether it's Dr. Wade Pfau or other academic research, policy research, is abundantly clear that part of the answer has to be including housing wealth in that retirement income stream through multiple. So it's not coming from within the industry. It's independent research around the notion of how do we close the retirement cash flow gap for seniors. And Wade Pfau is a great example. He's been a good influencer for the financial advisor space in general, but it's not hard to find mountains of research supporting the notion of monetizing the housing wealth in responsible, efficient ways to help folks live those longer years of retirement, and to do so comfortably and responsibly.
Yeah. Well, and you and I both agree on that. And at the same time, I've also seen statistics that are talking about the baby boomer generation is going to be the largest transfer of wealth from one generation to another ever in our country. And when you consider that half of baby boomers are in jeopardy of running out of money before they die, and they're going to be transferring the largest amount of wealth to the next generation, there seems to be a problem and a solution that everybody's ignoring in plain sight.
Yeah. Yes. Well, I agree with that. And I think more and more financial advisors, in my experience, are beginning to not ignore it and begin to say, hey, as a part of my fiduciary responsibility to really understand my client's entire picture, how do I begin to understand more the available tools and options that are out there, and that allow my client to maybe leverage their full scope of wealth, which includes housing wealth by definition. And so, yes, we're seeing more and more clients do that. And frankly, it's a unique situation, because if you follow the math in, for example, Dr. Wade Pfau's book, and many examples and use cases that we've done with advisors and their clients, and we have, as you know, 2 financial planners that are a part of our team who ran their own practices for many years, and who we convinced to come help us in this cause, who do this every day with clients and other financial planners. The fact is, by leveraging the housing wealth, what we've seen in the use cases and the data is you can not only do you solve the client's problem and increase the probability that they will have enough money and cash flow to live the sort of retirement they want in those extended years, but you also preserve assets under management while doing so, which helps deliver better outcomes for the client, preserves that book of business. And the other unique thing, which is truly unique around our product, I believe, is this point you mentioned, Gabe, about the asset runoff on the transfer of wealth that advisors see, is often our product, our clients are pulling in the adult children. They're pulling in other family members to help them with the decision, because they're stakeholders in the decision. And so while I don't believe it's the majority of the time, and I don't have data to quantify it, I will tell you, often we hear where loan officers are working with clients bring their adult children into that discussion, and the financial advisor is sitting around the table with the adult children. So we get to broaden that advisors, help them form relationships with the adult children of the senior, who they may not otherwise meet. And that's an opportunity to maybe not lose those assets on the transfer of wealth, which is a unique nuance to our business, but we do see it happening often enough to be talked about in our business.
I see that often as well, and it's the sandwich generation. You and I are both part of that, where we're fortunate enough to have a parent who's still alive, and children who we're dealing with, raising our children financially, and also still planning for our own retirement someday, right? Whatever that might look like. And I think that the concept and idea that for us to be financially supporting an adult, a parent, right, or even a grandparent maybe, is financially detrimental to our own retirement and our children's, whether it's their college or their future wealth building opportunity, correct?
Yes, 100%.
So if we can help clients be financially independent and not become a burden on the next generation, because that happens unfortunately from time to time as well, that it's a win-win-win all around.
And it's what the clients want. There's research. I can't think of the specific research right now, but I could follow up with you. And there's likely a mountain of research on this as well. But
Sure.
there's research around the clients themselves. And you mentioned the boomer generation. Well, the boomer generation spans a lot of different sub client segments in there.
Sure.
And I think about my mom, who's 75 right now, is different than a 75-year-old from 10 years ago, 12 years ago when I first got into the business.
Sure.
And today, what our clients, they fiercely value that independence and not being a burden on their families, which has typically always been the case. They also want to travel, and they have a punch list of things they want to do in retirement. And so it's not just being comfortably retired and hanging out. It's they're thinking more, I think, purposeful about, well, where do I want to retire? What is my retirement home? Is it where I raise my family, or is it someplace else, in a community near my grandchildren who may be states away, or in a community with the sort of transportation access to services and entertainment that I'm accustomed to? So not only will you and I as adult children, the Sanders generation, have these multiple financial considerations, right? But my mom doesn't want to be a burden to me. And many of our clients don't want to be burdens on their family.
Sure.
And again, it goes back to working with those family members and the stakeholders, financial advisors included, that those clients trust, to unlock some of that optionality that's tied up in the home equity in their home.
Absolutely. And when you talk about unlocking the optionality of the home equity, in my opinion, is one of the most efficient assets that you can have in retirement, as long as you have a tool to access it, because of the tax efficiency, in regards to the fact that when you're utilizing home equity or accessing home equity, there are no income taxes associated with that money. Right?
That's correct. Yeah.
And so by utilizing some of the home equity and not having to pay income taxes on that, versus having to pay taxes on most retirement assets outside of a Roth IRA, right? It does become a really efficient tool and strategy. The other piece that I think is really important that I come in contact with a lot is the emotional side of not having the financial stress and burden that comes in retirement a lot of times. When people, I believe the number one thing that most people are concerned about are finances in retirement. It's not dying, believe it or not.
Research is clear on that as well. Yes.
Right?
Yeah.
So it's the financial stress and burden that people deal with. And I see it. I literally will sit around this table, have a closing, and I can watch people's shoulders just drop physically when they do the reverse mortgage or home equity conversion mortgage. And I think that this whole space is so powerful in so many different ways. So as we're wrapping up here, talk to me a little bit about maybe where you see the industry going. Where are we headed to next?
Well, I think it's anybody's guess. In my own opinion, and part of the reason I got back into the business was I think the data and the research is clear on the points we've been talking about. The demand has never been stronger. The level of housing wealth has never been larger. The awareness around the notion of leveraging housing wealth as an integrated part of that retirement income stream, I think, is higher than I've ever seen it. The product itself, the reverse mortgage product, I think has never been better positioned for more mainstream use, meaning post the financial crisis, the consumer safeguards that went in, and this is something that's often missed, that I think the safeguards that went in around underwriting for a client's ability to repay the loan, being able to do impounds or expect set-asides of equity to pay taxes and insurance, protections for non-borrowing spouses, caps on origination fees. All of those consumer safeguards have made the product more scalable, in my view, more beneficial for clients, have mitigated some of the risk, have made the products more digestible for adult children or financial advisors and others who care about their seniors. So I think the foundation is set, in my view. You have huge demand and need in a purpose-driven way, right? People want optionality because we have bigger acute problems to solve. So you have an acute problem, which is the retirement crisis with headwinds coming. You have trillions of wealth that the research shows can be responsibly used to offset and solve that problem. And you have a product that has the right consumer safeguards in place for more mainstream application. So I think that sets the industry up well to serve more people, to serve more referral partners who are trying to solve problems on the behalf of clients. Yeah. And I think the industry is beginning to turn attention to how do we, and we've done a lot of this within OneTrust, and this is sort of the tip of the spear for us is, okay, all of those things are set well to affect change and help business partners and clients and communities navigate this successfully. So what do we need to do? What do we need to bring to the table in order to be a catalyst for more usage and adoption? And some of that is around the industry continuing to invest. And I spoke about some of this at the NERMLA conference. Now it's very early stage. The industry, I believe, needs to work in a systemic way to further these causes a little more. But how do we invest in technology in the industry in similar ways that we've seen in the traditional mortgage space?
Sure.
We've underinvested as an industry in technology to improve service levels for clients, loan officers, investing in our people and continuing to pull more professional loan officers into the industry who have the financial acumen and the mortgage banking experience. We have some, not enough in the industry, right? So mainstreaming the product and all of these changes we're talking about opens the industry up for more professional, talented individuals to join and begin to use the product, and then you're distributing it across a broader customer base. So I think the industry has to keep investing in our people, keep investing in our technology, keep investing in our servicing capabilities for clients once the loan funds. The client interacts with us a lot post-funding, and so making sure that we've continued to invest in the servicing capabilities and access to funds for clients. And there's been a lot of progress in the last 5 years on the servicing side as well, which I'm happy to. It's a whole other discussion. But I think those sort of common sense investments in our people, in technology, in our clients, and our referral partners will allow us to continue pushing on that 2%. And helping more people realize the benefit.
Yeah, well, you and I are on the same page. I mean, dating back to 2014, right, with the non-borrowing spouse changes that you referenced in 2016, with financial assessment, talking about the set-asides and escrow account, there have been so many improvements to this product in the space that have made it a better, safer program.
Yes.
And with that, I think that the adoption rate will improve. And you and I both agree. I think that the industry can continue to take on more and more professional originators that understand the risks and the concerns around retirement. I think that that's one of the big differentiators where we need the partners from the financial advisors, right? From the tax professionals, CPAs, so that we can truly create a cohesive plan for our clients in retirement. Because one of the things that I've realized in this space is that we all grow up, I shouldn't say we all, but many of us grow up learning how to save, or at least taught that we should save. And we're taught how to spend money. And many of us are taught how to spend safely, but nobody is taught, excuse me, I said that wrong, how to save, right? But nobody is taught how to spend safely. So when you get into retirement, I look at it as like climbing Mount Everest, right? When you're in your working years, you're saving money and you're climbing Mount Everest. But unfortunately, many people actually fail or die on the descent, not the climb. And what I'm getting at is nobody really understands how to spend their retirement savings safely. And that's where I was getting at with the partnership of the financial advisor and the tax advisor is they have the tools and the expertise around creating a cohesive plan for our clients. But this is such a powerful and needed tool that so many people can utilize and should utilize that that's where I'm coming from, that the adoption rate can be and should be significantly higher with the partnership.
Yes, I agree. When we put the work in, I mean, the data research is there. The financial advisors, attorneys, CPAs, folks that seniors trust to help them navigate these years, have those trusting relationships. You've done a great job of, they trust you with their clients. So as an industry, we need more professionals who those other stakeholders can trust with their clients. And that's the investment in our people and our business, and we'll keep doing that. And I think we have some of the strongest at OneTrust. You're a great example, top of the list there on just the best that the industry has to offer, in my view. When you think about the overwhelming amount of data and research that points to this, and you really sit back and look at the compelling math that's there to help people descend safely and responsibly spend in their retirement years. The beauty of what we do for a living is it's all about creating optionality and choice, which is great for people. And in the process of doing that, there's a risk mitigation. There's a conservative play to this. As I've spent more time with financial advisors or our own financial planners and elder law attorneys and estate planners on this topic, my thinking over the last 5 years has become more clear that this is really a strong play, not only to create choice for folks as they choose how to spend during their retirement years, but it's a risk mitigation tool around the risks that people face while they're descending Mount Everest. And I think that's the beauty of this that is really underappreciated at large with consumers and the industry at all, is that this is empowering and it mitigates risk for seniors as they're navigating through those. How do I spend responsibly during retirement?
And spending responsibly, and I think with that, this is a tool that allows you to spend anywhere you might need it, whether it's home improvement, whether it's everyday living expenses, whether it's long-term care expenses, whether it's gifting and legacy planning. It can be used for anything and everything, as opposed to a traditional product, whether it's an insurance product like life insurance or disability insurance, where it has a specific need and a specific, usage. This can be used for anything. So the versatility and optionality you reference, I think, is extremely powerful and quite honestly misunderstood.
It's empowering, and that's really whether you're a financial advisor, a CPA, an elder law attorney, estate planner, or an adult child, you want to empower those who rely on you. And I think this tool is quite simply just an empowering tool in that way, not restrictive. And it's funny, we'll get into a conversation. My mom, who's a critical care nurse, referred me a couple of years ago, a dear friend of hers that I knew growing up. So that's always an interesting conversation. They were critical care nurses for years, saving lives. And it was her and her realtor friend who cared about her. And she was in a jam, and we were talking about the reverse mortgage as a possible solution versus other choices, because people believe this is an expensive option, and it always sort of depends, and as compared to what, right? And when you think about how do you access your housing wealth, and you have this discussion with advisors and clients or adult children, whoever the stakeholders are around the table, and you can pull some of the emotion out of it. It's like, okay, let's just understand. We know you want access to the equity in your home to solve this acute problem. What are your choices today? How do you go after that? And in her case, she was thinking about selling the home with a 5% commission, wasn't discounted. You would have thought that she would have a little bit of a discounted rate. But when you think about the cost of moving, selling your home, finding a new place to live, the cost of the move itself, and when you start stacking up some of the cost of choices to unlock that equity, versus paying the FHA mortgage insurance premium, which has huge value down the road as an insurance product, or the cost of and the other cost of just doing a reverse mortgage, I'm not so sure it's an expensive choice when you think about the customer lifetime value that the client gets out of this, that the advisor or referral partner may get out of it because of the work that they're helping the client with, versus other choices. So it does create optionality, I think, at a reasonable price with great lifetime value to the client and to those stakeholders.
I don't disagree. And that's probably the number one concern that many people or clients and advisors have when I sit down with them and go through a proposal and I show them options side by side is that upfront mortgage insurance. At the end of the day, 2% of the home value or max claim amount can be pricey. But as you said very well, compared to what? Right? When we look at that and you look at the tax efficiency and you look at the long-term planning of a product like this, that I've shown mathematically that that cost can be offset and then some from the tax savings and the growth opportunity in the portfolio.
Yeah.
But you have to look at it holistically, and you can't just look at this product and the cost by itself, which is, again, where I love partnering with financial advisors because they can look at it and say, yes, here's a bucket that's tax deferred. Here's a bucket that's taxable, and here's a bucket that's tax-free.
Right.
And if we can pull from either one of them at any given time to effectively reduce the AGI or adjusted gross income to then hit a lower tax bracket, it's a win-win-win, again, all around, offsetting that upfront cost.
Yeah, which is why I think we work best when we're working with CPAs, attorneys, realtors who understand the nuances of, in my example with Nan, I didn't mention the capital gains tax.
Sure.
And so at a high level, it really just, you want to work with referral partners who really have that robust knowledge you're talking about, because then it allows you to step back from, oh, this is an expensive option. Well, no, you're unlocking a lot of choice and empowering folks to make decisions. And it's efficient when you start looking at the costs, the potential tax advantages,
Sure.
and referral partners who are on their game also understand that, and they already have trusting relationships with those clients. So it makes for an enriching business, and you have an impact on your client's life, and you add value to your referral partner's business as well.
Absolutely. And you just touched on the capital gains taxes. And recently I've met with a handful of clients here in Colorado that, interestingly enough, if they bought their house in the 70s, they paid 70-something thousand dollars for their home. They bought their house in the 80s, they paid 80-something thousand dollars for their home. And now today, in a lot of cases, it's worth over $700, $800, or $1 million. And they're likely going to have to pay over $1,000 in capital gains taxes if they sold today, depending on their overall tax situation. And so, Jesse, I appreciate you being here, appreciate your insights, and certainly appreciate what you're doing for the industry and what our company is doing for the industry as a whole.
Well, it's been a pleasure. Thank you for the invite. It was a great visit, and I appreciate what you're doing, not only for your market here and your community here in Boulder, but for our team overall.
Thank you, Jesse.